Hello everyone, it is Friday, March 5, and today we will take a closer look at the charts for the euro and the British pound to assess potential market movements. As seen, the euro has reached a new one-month high following the European Central Bank's decision to cut interest rates by 25 basis points. These moves set the main refinancing operations rate at 2.65%, while the deposit facility rate was lowered to 2.5% from 2.75%. Although the ECB signaled the possibility of more rate cuts, it also reassured investors that any future moves would be cautious. During her press conference, ECB President Christine Lagarde faced numerous questions from the media, particularly about whether the central bank would continue to support Europe as a whole, and Germany in particular, in its initiative to rebuild defense capabilities and stimulate its economy, especially after the United States declined to assist in this matter. Lagarde emphasized that the ECB had no intention of increasing spending and would remain focused on its core mandate. However, she did not rule out the possibility that such stimulus measures could boost the economy. In light of these developments, the euro's upside momentum has slightly slowed. This is hardly surprising given the significant gains it has made recently. The euro has surged by more than 500 pips since February 28, which suggests a correction is overdue. As such, today's bullish run is now in question. Yesterday, traders also received data on US initial jobless claims. While the figures came in below market expectations, they remain elevated, signal a slowdown in the labor market. This development is likely to increase pressure on the Federal Reserve. Recently, there has been growing speculation that additional interest rate cuts may be necessary to support the economy. Let's take today's macroeconomic calendar. It includes a speech by Christine Lagarde, although it is unlikely she will provide any new insights. Also on the agenda is data on Eurozone GDP growth for the fourth quarter of last year. The figures are expected to remain unchanged, rather weak at 0.1% quarter-on-quarter and 0.9% year-on-year. Notably, economists have recently downgraded their growth projections, and if today's data disappoints, it could reinforce the view that the euro area is heading into a recession. Regarding the United States, the unemployment rate is forecast to hold steady at 4%, continuing its downward trend since November 2024. A further decline in unemployment would likely boost demand for the US dollar. The key focus, however, will be on US non-farm payrolls, with expectations for an increase of 159,000 after gains of 143,000 in January and 307,000 in December. A stronger than expected payroll report could strengthen the greenback. Conversely, if the data disappoints, the dollar could face more pressure as the changes of further interest rate cuts in the US rise. Also worth noting are figures on average hourly earnings, private payrolls, and comments from Federal Reserve officials, including Jerome Powell, ahead of the upcoming policy meeting. Turning to the technical analysis, the EUR USD chart shows that a false breakout at 0.783 would trigger a buy signal, with the euro targeting the resistance levels of 0.818 and 0.851. A false breakout of these marks would make it possible to open short positions, dragging the euro down to 1.0783. If the price breaks through and fixes below this level, the European currency could extend weakness to 1.0749 and possibly 0.715. At this mark, I would recommend going long on rebound in anticipation of a 30-35 pip move. Long positions at 1.0749 and 0.783 should only be considered following a false breakout. In a bull case scenario, a break above 0.818 could trigger a rally to a new one-month high. A move above 0.8 28.52 would pave the way for further gains towards 08.85. At this level, it would be wise to go short on the rebound, aiming for an intraday correction of 30-35 pips. Speaking of the British pound, a false breakout at 1.2890 and 29.19 would generate a strong sell signal, pushing sterling back to 28.51. At this level, buyers are likely to take control, potentially triggering a long positions on a false breakout. Alternatively, if the price extended losses and breaks below 28.15, the pound could dip to 28.08. At this level, traders are advised to go long on a rebound to catch an intraday correction of 35-40 pips. If selling pressure remains subdued, the price could break through and consolidate above 28.90. In this case, sterling is expected to climb to 29.19, potentially reaching a fresh 1-month high around 29.46. At this level, I would recommend going short on the rebound, counting a 25-30 pip move by the end of the week. Going long at 1.2919 and 28.90 would only be relevant after a false breakout. Best of luck to all and have a great weekend.